this month we have 3 very different stocks for our 3 stocks to buy for August 2020 video. It's going to be an exciting video. You guys are going to learn a ton from this video, so stick around to the end. And as always, smash that like button down below to show your support for the channel. It helps out a ton. But without wasting any more time, let's get into stock number 1. Our first company this month is Five Below, and it's a stock that's currently down around 16% on the 1-year chart and nearly 25% from its all-time highs. It's been moving sideways for the most part recently and caught my attention, so let's look into this business a bit more. So what is Five Below? Maybe you've heard of this company, maybe you haven't. Let's spend a second here to discuss the business. Now, it may be a new business to you, and it's one that I haven't talked about on the channel before, but they are a discount retailer, and they're one of the fastest growing ones supposedly that focus on selling items under $5 primarily. They do sell some products above $5, but as their name implies, their core bread and butter is really that $5 and below mark. It's essentially like a dollar store, if you will, with some more expensive items and pretty good value as well. As of today, Five Below has nearly 1,000 stores across 38 states in the US, and this company is very interesting to me right now because of the environment that we're in. Now, Five Below does do online shopping as well for their items and offers a flat $5 fee for any order, big or small, which allows them to optimize their business during these times where people prefer shopping online. I think this is a critical step for any business during these times, and although I personally haven't used their online store, I'm curious to hear if any of you guys watching have. Let me know in the comment section down below if you have, and let me know your experience on that as well. Okay, so here's kind of the value prop for the business from an investment perspective that the company lays out. They're a leading high growth value retailer, and I think they've done a good job here proving this out over the years. They have a long runway for unit growth. They have a compelling new store model. They have consistent performance, and they have benefits from scale. This graphic here shows us the uniqueness and why they're better than their competition, which more or less would be like your other regular dollar stores like Dollar Tree or Dollar General. The key differentiator here with this company versus other discount retailers and dollar stores is their focus on the youth. This, in my opinion, will help them over time build a strong, loyal customer base as they grow up with their products. Dollar stores kind of have this negative connotation and image of appealing to older customers that are looking for cheap products. And what Five has done here is taken that same model, modernized it, and made it a lot more exciting for younger people. I also do like the insight that they provide here, breaking down their customers' average income, and we can see a good mix of low-income earners and high-income earners, implying that the value they provide at their stores with their products that they sell are generally seen by the general public as good value. Now, while you may think that these discount stores are good during recessionary times, the global issue that we've had has uniquely impacted any sort of retail store, and unfortunately, this company was a victim as well. They reported some pretty big losses recently as sales declined by 45% and comparable sales were down by 52%. They did, however, open a few new stores as they are still focused to keep expanding their business. That being said, the net result loss was just over $50 million in the quarter. They did make repurchases of their share, presumably in the first half of the quarter before things got a lot worse. So this tells me in normal economic times, they are a relatively healthy business. Now, this is an overview of their income statement comparing year-over-year performance, and it shows us just how hard hit they were in Q1. But they do state that their Q1 actually ended in May, so they did take a brunt of the lockdowns and was expected to be a total disaster for them. That being said, while things are looking tough this year, next year is expected to come back to growth and some impressive growth at that as well, with revenues expected to climb 33.4%. This, guys, is a high growth business and a very strong sign that a bounce back recovery is expected for the company. Now, because Five Below is not really a large, well-established business, I do want to spend some time here looking at their balance sheet because that will give us an idea of how they financially stand today. They haven't really proven the test of time over a long period of time, so the financial statement, in my opinion, does play a larger weight here. So their assets look pretty good, but the cash balance took a hit year over year. They're sitting at $69 million versus $220 million a year ago in cash, and current assets is also down year over year. Total assets, however, for the business is up year over year, sitting at around $1.9 $1.93 billion, but this is primarily because of the increase in inventory and operating lease assets. With liabilities, this also got a lot worse year over year. Current liabilities went from $320 million to $368 million, and total liabilities climbed from $956 million, crossing over that $1 billion mark to $1.24 billion. So what I see here is a business with a decent balance sheet, and they have assets to cover their liabilities, and they have around 1.56 times more assets than debt. Ideally, I'd want to see a 2x or higher here for the assets to debt, but this is still a good enough position for me from a financial perspective to consider this business as a possible investment. So this is a very interesting business, guys, and I think their focus on the younger generation here is actually going to help them pull apart from the other dollar stores, the other discount retail stores, and really be in a niche of their own. Clearly, we can see from next year's expectations, they have good potential for growth, they have a good balance sheet, and they have a good brand behind them as well, because they've done an excellent job, in my opinion, with their marketing. I think this company is poised to succeed over the long term. I think it's a very interesting play, and it's actually one of the few retailers that I would actually consider adding to my portfolio at the right price. PepsiCo is a classic blue chip company that is one of the most stable and consistent stocks in the stock market. It's seen as a recession-proof company because in good times and in bad, people need to eat and drink, and the product portfolio of PepsiCo caters to this. They sell everything from chips and snacks to pop and juices and much, much more. They own brands you probably consume on a regular basis and not even know that it's a PepsiCo product. What I find personally interesting about Pepsi right now is their recent venture in the DTC or direct-to-consumer space with their snacks.com website. On here, consumers can order snacks directly from the company with a minimum order of $15, and there's no shipping fees. Most, if not all, your favorite brands and flavors of snacks are available here, making this a very appealing option for consumers to purchase snacks. I can really see this website being used mainly for things like big events or parties, because it's so easy to use, so easy to order, and everything gets shipped directly to your door from the manufacturer themselves. Although Pepsi is seen as a very boring company traditionally, I think ventures like this is what sets them apart from some of their competition and makes them very intriguing here from an investment perspective, which is why I want to buy more shares. Now, in terms of the stock performance, it's pretty much been flat on the year and has been moving sideways for most of it, except during the volatility we saw in March. But while you were holding the stock in the last year, you have been earning consistent dividends that this business has grown by 8% or so for the past 48 straight years. This shows dedication and determination to value and prioritize shareholders, and is another core reason I love this company. Clearly, you can see there's a lot of exciting stuff going on at Pepsi here, and just recently they reported their latest earnings results. So on this table the company provided, they didn't have a great quarter as consumer spending did decline in general as people stayed at home and were afraid to leave their houses in late March and early April. But in my opinion, this is fairly negligible performance here considering how large the business is. Year to date, they still have positive growth and they still have organic revenue growth that's doing well as well. Now, you never really buy Pepsi for massive growth, and here you can see this year and next both see modest growth in the business. But if their snacks.com venture really takes off, it will help them increase margins and as a result, increase profits, making this an even stronger business. From a fundamental standpoint, this business has been around for a very long time and has proved the test of time. And as a result, I'm not too concerned with their balance sheet. I took a look at it and I think it looks pretty good for what it is. And because it's such a consistent and safe business, I don't have any concerns with any of their liabilities. Pepsi also has a great management team that supports the business and has made some excellent decisions over the years in terms of acquisitions and all these kind of things, which has really propelled the business to be pretty much my favorite type of company in this space. As an investor, it really gives me confidence investing in this business. It really gives me confidence putting more money into this business because I know there's a great team behind the scenes that's executing well on all fronts. So now both Pepsi and Five Below are both non-tech companies, so I did want to include at least one tech company here in this video. But I want to be completely upfront and honest with you guys. It's not really a company that I'll be adding to my portfolio right now at these prices, and that's because I think there's some flaws with this company we're about to discuss. That being said, it is a giant, it is a stable company for the most part, and it isn't going away anytime soon. And I know a lot of you guys have been asking me for some tech stocks that are undervalued, and that's why I really wanted to include it in this video. And no, the company is not IBM. So Cisco is a telecom giant which is big on networking, switches, and infrastructure for businesses. They've established themselves as a major tech company, but in recent decades they have fallen behind with their technology, in my opinion. Services like WebEx has benefited from the lockdowns and work from home orders, so that's a positive for the business, but in my opinion, they aren't adapting fast enough with their cloud technologies to be able to compete on the scale that Microsoft is, for example. This is a major reason I'm personally not the biggest fan of Cisco right now, but that being said, given a cheap enough price and valuation on this company, I would consider opening up a position here. This is because while I feel that the business is falling behind right now to the competitors, I think that they can be kind of like an IBM where they have consistent profits coming in regardless of whether the business is slowly declining or not for decades to come. The one-year chart for Cisco isn't fun, down around 20% or so, and some may argue that's where the value really lies, and there is value here today. But again, I want even lower prices for me personally. Q3 for the company did see some declines year over year across all of their geographic regions, but margins increased across all these regions. The breakdown here of their revenue segments give us a better idea of what's hurting, and we can see that the other products category is the main culprit, but other segments here did decline as well. Now their security and services business did see a bump up though, and this is in line with the new world we're in where everything is moving towards a services model. There's also now a massive need for security, cybersecurity, all that kind of stuff, and that's kind of where Cisco is seeing some success. Cisco is really known to go out there and make big acquisitions on companies that are doing well or are market leaders or just have good technology behind them. And I think that any investor who is investing in Cisco should be aware of this because they have made a lot of acquisitions over the years. Some have panned out, some haven't, but it is definitely something I see this business continuing to do moving forward. Now, overall expectations for growth are fairly low for Cisco, even though it's a tech company, and they aren't expected to see a whole lot of growth across their business. That being said, if they are able to transform quicker than expected to a subscription model, there's potential to blow these revenue estimates and realize some handsome gains in the stock. So think of it this way, everyone's kind of expecting little to no revenue growth in this business over the next year or so. If, however, they're able to come out and say, you know what guys, we grew by 2 or 3 times what was expected, then all of a sudden investors get excited, the stock's going to start reflecting that, and we could see a nice bump up in the stock price. That's not going to happen overnight, it's probably going to take a few quarters, if at all, but it is definitely an angle you could play this business with as an investment. Now, of course, will that happen? I don't really know. That's something we'll have to look into our crystal ball to find out, and I don't have mine available right now. But I will say this, out of the 3 businesses we talked about today, Cisco is my least favorite, Pepsi is my most favorite, and Five Below is kind of in between there because that's a high growth company. There is more risk involved with that, but I think I do see some good upside potential if they continue executing. And guys, I want to do something fun for this video. So if you're given $10,000 today, and you're told you're only allowed to invest in Pepsi, Five Below, and Cisco, how would you break down that $10,000? Let me know in the comment section down below. I'm very curious to see how you guys would allocate that capital. And yes, let's just pretend that you have to deploy all that $10,000. Can't hold anything in cash, and it must be at least in one of these 3 businesses. Either way, guys, hope you enjoyed this video. Hope you found value in this video. Smash that like button down below and share this with a friend to help with the YouTube algorithm. Thank you so much for watching, guys. Don't forget to invest positively, and I'll see you in the next one. Peace.